Hello, and welcome to my video. Today I will be discussing progressive taxation and how it compares to other forms of taxation. Now, progressive taxation is one of those topics where I very frequently hear it discussed, but I often hear it misunderstood. If you've ever heard someone make the argument of how they don't want to take on a bonus or more money at work because they're afraid of paying more in taxes, that's really why I put this video together. I'll get into more detail later, but basically, just because you're pushed into a higher tax bracket, that doesn't affect the taxes you pay on any income up to that bracket. Now, moving forward, there's three basic types of taxation: regressive, flat, and progressive. We'll be discussing each of these in a bit more detail in later on slides. Starting with regressive taxation, in this method, the effective tax rate decreases as the amount subject to taxation increases. Some examples would be sales tax, at least most of the time. Lower income people will likely spend a higher percentage of their income on essentials than higher income people, meaning a higher percent of their lower income people's take home pay will go to paying sales tax on those essentials. Now, realistically, many times when people start making more money, they start spending it as soon as they start making it. But I do still see where this argument is coming from, as true essentials really aren't going to vary in cost for anyone, no matter how much money they make. One example that I believe is a little less subjective and more straightforward would be the Social Security payroll tax. In 2025, the rate is 6.2% for both the employee and the employer. However, this tax is capped at $176,100 of earnings for both parties in 2025. Now, a big call out I want to make for this is while the max tax may be capped, the max benefit you can get in Social Security benefits is also capped. Oftentimes, I hear politicians talk about how this payroll tax shouldn't be capped, but they don't mention how the max benefits are also capped. Now, you may have disagreements over if the max tax is at the appropriate level compared to where the max benefit is, but really, you should be discussing both of those items together rather than just one and ignoring the other. Next up is a flat tax. This is by far the most straightforward of the three. In this method, a flat rate is applied to income regardless of how high or low it is. Whether you make $50,000 a year or $500,000 a year, you're going to pay the same rate. There is no difference between the effective and the marginal rates in this system. Finally, we have the progressive tax system. In this system, as you earn more income, income above certain thresholds starts to be taxed at higher rates. Now, having income above a threshold does not affect the rate you pay on income below that threshold. Let's say, for example, tax rates are 20% for income 50,000 and under for a single person, and 30% for income $50,001 and above. If a person makes 51,000 of taxable income in a year, they would pay 20% of the first 50,000 and 30% on the next 1,000. They would not pay 30% on the full 51,000 just because they crossed that threshold. In this scenario, they would pay 10,300 or 20.2% of their income in taxes. The 20.2% is their effective or average rate. Their marginal rate would be the 30%, as any incremental income would be taxed at that higher rate. Now here I just copied in some text directly from the IRS website showing what the tax brackets are for 2025. One call out I want to make is that the income levels above are all taxable income. You would find this on line 15 of a 2024 1040. This is basically income after all deductions but before any tax credits. Now moving over to Excel, I put together a simple little model to show how marginal rates could differ from effective rates. A quick call out I want to make on this little model, as it's very simple. It does not account for long-term capital gains or qualified dividends or potential net investment income tax. This is purely to show effective versus marginal rates based off of ordinary income. Now in this example, I have 150,000 of taxable income to start. The marginal tax rate, any income above 150,000 would be taxed at 24%, while the effective tax rate is 19.23%. All in all, this would result in federal tax due of a little under 29,000. Moving over to this table, I have what the cumulative taxes will be for each of the tax brackets. This is basically however much in taxes you would pay if you meet this threshold but don't go above it. So for this first example, if you make 11,925, that would be taxed at 10%. So that's what this number is. And each of these numbers just basically continues that. So for example, this 5,579 takes that 1193 and then adds the 12% of the difference between this 48,000 and this 11,000 figure, and so on and so forth. Now, if you want to pause the video, I included the exact formula I used for this federal tax due calculation. This first section is pulling in the cumulative tax. So in this example, it would put you in the 24% bracket. So everything getting up to this 103,350, you would pay 17,651. The second part takes the difference between your taxable income and the next income threshold below where your income sits. In this case, that would come out to 46,650. This last piece simply takes your marginal tax rate, so in this case 24%. So what this formula does is it takes 17,651 of cumulative tax and adds that to the product of your incremental income above that threshold times your marginal rate. I hope this video was helpful to you. If it was, please consider liking and subscribing. If you have any questions on what I discussed, or if you have any ideas for what you'd like to see in other policy or financial topics, please let me know in the comments. Thank you and have a great day.